The 2025 housing crash is no longer a chilling prediction. It is a brutal, undeniable reality. Across the United States, specific cities are already buried under foreclosure numbers and equity losses that evoke the worst days of the 2008 financial crisis. This narrative transcends the simple adjustment of prices. It is about watching the structural foundations of entire local economies start to aggressively unravel in real time. The unsettling truth is that a dangerous number of people, homeowners, investors, and analysts alike, still cling to the delusion that this is merely a temporary market dip that will inevitably bounce right back. That belief is an expensive, potentially ruinous mistake. This is a deep structural failure of overvaluation, amplified by crippling external costs and the mass exodus of temporary demand. Home values are not slipping gently, they are plunging, in some cases by half or more. The fundamental question is, where did the speculative bubble finally burst? Where are homeowners now financially trapped, owing more than their devalued asset is worth? And why, for countless families who bought at the peak, has the American dream been quietly and brutally repossessed by the forces of high debt and climate risk? This 500-word manifesto is a journey through 10 cities where home values are experiencing catastrophic, non-cyclical declines. We will show you precisely where the bubble burst, dissecting the true scale of the financial devastation, the 40% to 60% price plunges, the ruinous insurance costs, the collapsing investor-driven rental markets, and the permanent shift in economic psychology. Prepare to understand the full scope of this market reset, armed with the knowledge necessary to avoid making a very expensive mistake in a landscape defined by panic and price capitulation. The coastal and Sun Belt crush insurance and climate risk collision. The regions that benefited most from the pandemic migration, the Sun Belt and coastal escapes, are now confronting their core vulnerabilities. The dream of affordable sunshine has been violently undermined by non-negotiable fixed costs, crippling insurance premiums, and escalating climate-related infrastructure expenses. 1. Palm Springs, California. Desert luxuries half-value crash. Palm Springs, the global symbol of mid-century style and warm weather escape, saw home values climb to astonishing levels, nearing $1.2 million in median price by early 2022. By 2025, those same medians have fallen to the high $500s, zeros in many areas, a decline of more than 50%. In some short-term rental zones, the drop has been even larger, wiping out years of paper gains. The collapse is multifaceted. Heat waves have intensified, and local officials have aggressively tightened short-term rental rules with new permit limits and steeper fines, changing the financial math for investors who relied on high occupancy to cover costs. Insurance has become a major pressure point. Increased wildfire risk has caused several major carriers to scale back coverage or exit California entirely, leaving households facing higher premiums and limited options. Energy costs in this necessary air conditioning climate have continued to move upward, and water restrictions and fines add another budget line. The economics of ownership have changed sharply. Homes bought as rental vehicles now struggle to generate enough income to justify their carrying costs after utilities, maintenance, management, and taxes. Palm Springs is a stark example of what happens when style, speculation, and environmental risk brutally collide. 2. Cape Coral, Florida. The 40% insurance catastrophe. Cape Coral, once the perfect setup of canals and sunshine, is now defined by a catastrophic financial reality. In less than 2 years, the median home price has fallen from around $465,000 to roughly $160, a decline of more than 40%. The slide is ongoing. The true shock is the insurance crisis. Homeowners here are not just facing higher premiums, many are being dropped altogether. It is now common to see annual homeowners insurance quotes of $8, $0 to $10,000 on properties worth around $300,000. This fixed cost keeps rising while the asset value sinks. Hurricane Ian tore through Lee County, leaving lasting scars of soaring rebuilding costs and delayed government assistance. Homeowners associations still expect high dues, and special assessments often arrive when families are already financially stretched. Houses sit on the market for half a year or more. Price cuts are not adjustments, they are deep, desperate reductions. The Cape Coral dream has become a place where the cost of insurance, repairs, and financial uncertainty weighs against every decision, serving as a dire warning for every coastal market in the country. 3. Naples, Florida, luxury's fragile model. Naples, the symbol of Florida luxury, has seen average home prices fall sharply from their peak of around $1.1 million. In some parts of the metro, many homes now sell for close to half their previous numbers, with certain high-end condominiums seeing even steeper declines, challenging the fundamental assumption that prime coastal property only moves upward. Severe storms exposed the model's fragility. Hurricane Ian drove up the cost of rebuilding and renewed attention to flood and wind risk. Insurance premiums in Collier County have climbed dramatically, in some cases tripling in only a few renewal cycles. Policies that once cost a few thousand per year now run into 5 figures, crushing retirement budgets and investment plans. Naples is dense with gated communities and strict HOA letters, with substantial monthly fees and large special assessments for repairs like seawall reinforcement and roof replacement. For people who bought at peak prices expecting low-maintenance coastal living, the combination of falling values and relentlessly rising costs has been jarring, forcing many owners to quietly list properties, hoping to exit before conditions worsen further. 4. Myrtle Beach, South Carolina, the tourist trap. Myrtle Beach, the classic coastal playground, became an investment magnet during the pandemic. Since 2023, home values have dropped more than 45% in many segments, turning a surge into a steep slide. The trouble is a familiar recipe. Too many investors chasing the same short-term rental strategy, too many similar properties coming online at once, and a growing list of expenses. HOA fees now run hundreds of dollars per month even with maintenance backlogs. Insurance has fundamentally shifted. Rising concern about hurricanes and flooding has driven premiums higher, and carriers have reduced or canceled coverage after relatively modest events. For an investor relying on slim margins or a retiree on a fixed income, a sudden jump in cost turns a property from a financial asset to a crippling liability. Almost overnight, new development continues even as existing units struggle to stay occupied, feeding oversupply and pushing prices down while costs remain stubbornly high. Myrtle Beach confirms that coastal real estate carries risks far beyond the postcard images. The tech bust and exodus, urban and mountain collapse. The cities that saw the fastest growth due to remote work flexibility and tech sector expansion are now seeing the most brutal corrections as those remote work policies reverse. Tech companies trim staff, and high interest rates destroy the affordability arbitrage that drew migrants in the first place. 5. San Francisco, California, tech equity unravels. San Francisco, once the symbol of unstoppable tech wealth, has been fundamentally tested. From a peak median price near $1.6 million, values have slid to under $900. Zero in many parts of the metro, a correction of more than 50% in some segments. The psychology of the market has irrevocably shifted. The prolonged shift toward remote work left downtown offices underused. Commercial vacancies climbed, and surrounding residential buildings felt the impact as daily foot traffic shrank. Buyers who once paid a premium for proximity to major headquarters now question whether those addresses hold the same value. Residents who bought small homes or condominiums at peak prices are feeling the severe weight of property taxes, association dues, and insurance costs that did not fall with market values. Whole fees can run into four-figure territory, while essential upgrades, seismic, plumbing still wait. Wildfire risk nearby has shaped the insurance landscape, pushing up premiums and limiting options. San Francisco's story is about what happens when tech equity and real estate speculation intersect, with infrastructure strain and affordability limits on the local workforce. 6. Austin, Texas, growth expectations versus reality. Austin's story looked untouchable, with home prices surging more than 90% during the pandemic run-up. By mid-2025, the median home price has fallen from around $575,000 to just under $385. Roughly a one-third decline, with more weakness still in the pipeline. The drivers are clear: large employers trimmed staff, and prominent tech firms slowed hiring or announced layoffs. High-rise rental towers now carry high vacancy rates and aggressive concessions. Mortgage rates above 7% have cooled enthusiasm for expensive urban living. Listings that once attracted multiple offers in a week and now sit for 4 to 6 months. Homeowners associations are costly, even when amenities are underused. Extreme heat, recurring power grid concerns, and rising utility and insurance costs add further risk. Austin is discovering what happens when growth expectations fatally outrun economic reality. 7. Salt Lake City, Utah. The Mountain West compromise fails. Salt Lake City drew national attention as an affordable alternative to West Coast metros. Between 2020 and 2022, home values surged roughly 75%. Since then, they have fallen more than 40% from that peak, pulling the median price from around $620,000 to the mid-300s in many areas. At the height of the boom, remote workers and new rivals bid aggressively. When interest rates rose and corporate hiring slowed, the tone changed. Listings that once received multiple offers now remain on the market for weeks and months. Sellers increasingly add phrases like motivated and open to concessions. Downtown rental markets have softened, with property managers offering free months of rent and gift cards to attract tenants. Environmental and structural risks, including growing wildfire concerns and increasing earthquake risk, are now influencing insurance and planning conversations. Salt Lake City's fast turn from hidden value to correction forces a reevaluation of how much growth the region can truly absorb. 8. Boise, Idaho. Temporary demands collapse. Boise, the quiet success story of the Mountain West, saw home values soar more than 70% between 2020 and 2022. By mid-2025, that surge had reversed violently. Prices have fallen close to half from their peak, with the median value dropping from the mid-$500 zeros toward the high $200,000s in many areas. The core issue is that too many buyers paid far above underlying local incomes. Remote workers brought big city paychecks, but when tech companies pulled back and remote work policies tightened, many higher earners left. Boise was left with home prices that reflected temporary demand, but wages more in line with its historic profile. Some properties have already passed through foreclosure, and others are being sold at steep losses, with owners losing 6 figures in equity on speculative purchases. Rents have begun to decline as vacancies rise. Wildfire risk and changing climate patterns are pushing insurance premiums higher. Boise shows how quickly a so-called hidden gem can become an example of what happens when investment arrives faster than sustainable, locally rooted job growth. The speculative markets implode, risk and regulation exposed. This segment focuses on cities where speculative investment, short-term rentals, flips and reliance on a volatile industry or resource created an unstable foundation. resulting in severe and potentially long-lasting market damage. 9. Phoenix, Arizona, heat, water, and overbuilding. In Phoenix, values have fallen sharply, with many estimates putting the decline near 50% from the peak, bringing typical prices back toward the low $300,000 for homeowners who bought in those top years. This is the difference between positive equity and being financially stuck. Investors bought aggressively, and builders launched large subdivisions faster than infrastructure could follow. When interest rates rose, the pace of purchasing slowed dramatically. Many listings now remain active for 5 months or longer. The environmental backdrop is critical. Triple-digit temperatures drive higher utility usage and costs. Long-term water supply from the Colorado River is under intense scrutiny, and certain new developments face tighter restrictions. Insurance companies are recalibrating risk in hotter, drier regions, resulting in more expensive policies and higher deductibles. Phoenix is discovering that affordability depends on stable utility costs, manageable insurance, and realistic home prices, not just the initial purchase price. 10. Las Vegas, Nevada. The rental gamble fails. Las Vegas embraced risk, but the latest gamble in the neighborhoods that ring the valley has failed. The median has fallen to the high to $100,000, a drop of around 60% in some segments. In the post-pandemic surge, short-term rental properties multiplied. Investors bought single-family homes and condominiums expecting steady tourism income. When travel patterns shifted and visitors became more cost-conscious, many units lost their edge. Occupancy softened, and owners discovered that their projected returns no longer covered their mortgages, taxes, and maintenance. Water scarcity concerns and record heat have drawn national attention, and insurance costs have risen as environmental risks become harder to ignore. Some households that bought late in the cycle now find themselves with negative equity. Las Vegas built its reputation on reinvention, but the current housing reset is forcing a brutal calculation about whether the potential reward truly matches the layers of risk. The systemic failure, the crisis accelerants. The market collapse across these 10 cities is not accidental. It is a profound structural failure accelerated by the convergence of debt cost, climate risk, and mass speculation. A. The debt cost shock and negative equity. The sustained presence of mortgage rates above 7% has destroyed the affordability arbitrage that fueled the growth in Austin, Boise, and Salt Lake City. This debt cost shock has combined with falling home values to trigger a widespread negative equity crisis in markets like Cape Coral and Las Vegas, meaning homeowners owe more on their mortgage than the home is worth. This scenario locks families into properties and ensures that market recovery will be a prolonged, painful process. B. The climate risk and insurance barrier. The most destructive variable is the collision of climate risk and insurance costs. In coastal Cape Coral, Naples, and fire-prone San Francisco, Palm Springs zones, insurance premiums have become the single greatest threat to affordability, often doubling or tripling and creating a fixed cost that rises as the asset value falls. This barrier is non-cyclical and non-negotiable, acting as a permanent depressant on property values in exposed regions. C. The speculative overhang and inventory glut. The collapse is amplified by the sheer volume of speculative overhang. Too many investors entered markets like Phoenix, Myrtle Beach, and Las Vegas, relying on unrealistic rental income projections. The subsequent inventory glut from investor panic selling and builder oversupply overwhelms buyer demand, ensuring listings sit for months and forcing deep, continuous price cuts. The 40% to 60% drops. The market cannot recover until this excess, financially distressed inventory is fully absorbed. The reclamation and call to action. The 2025 housing downturn is not a gentle adjustment. It is a full-scale reset, exposing the profound fragility of some of the most celebrated markets. The journey through these 10 cities confirms a clear pattern. The combination of unsustainable speculative growth, debilitating debt costs, and irreversible climate risk has created a catastrophic financial crisis. If you are considering buying in one of these exposed markets, you cannot rely on past price charts or sales slogans. You must look at the true, total cost of ownership, the soaring insurance premiums, the long-term climate risk, the job stability, the local policy changes regarding short-term rentals, and whether the workforce that makes the city function can still afford to live there. The pattern of price plunges: the 50% drops in San Francisco and Palm Springs. The 40% collapse in Cape Coral and Boise represents an immense, generation-defining opportunity for those with capital and patience. The panic is deep, the discounts are real, and the leverage is now overwhelmingly in favor of the buyer. The time for waiting for the gentle bounce back is over. The moment for strategic, informed action has arrived. Seize the discount, own the leverage, reclaim the American dream at a catastrophic bargain.